some more names and market trends to watch. Jeffrey Small's with us, President, Arbor Financial. Good to see you. So we have the Magnificent Seven. People love these names. They've had them for years. And now they're sort of scratching their heads because granted they're off the highs, but they're still great performers. What do you think? I mean, a name like Meta, for example, is a name you've been watching. Do you like this one?
Well, yeah, I've liked this all year long, and I've done very well personally in Meta this year because it's had an epic rise. Other than, NVIDIA, what else has done better? Not very much. And so Meta is something you definitely want to hold for the long term. They're definitely going to take advantage of the AI secular bull market that we're going to be going into next year. And so out of the Magnificent Seven, though, I would say some of them are still magnificent potentially, but a lot of them are priced to perfection. And so you've got to be very careful with things like NVIDIA and Tesla, even though they keep blowing out earnings, at least on NVIDIA side. Apple is also having a hard time, too, because 60% of their revenue comes from their cell phone sales, and they've been declining every quarter for the last 4 quarters, and we expect that to continue going forward. So, but things like Amazon and Meta and Google, I think, are really poised to really reap the benefits of the AI boom, and they're still trading, at least Amazon and Meta are, below their all-time highs.
Understood. So when you look at these names, and you mentioned Amazon too, Meta, Google, and Amazon. Would you say on all of those a pullback would be a buying opportunity? And how do you quantify the pullback or the dip? How does someone know it's the dip that's the one they're supposed to buy?
Well, I think the maximum dip we're going to see in these stocks, Nicole, is really around 10% from here for the remainder of the year. And when we see that 2, 3, 4, 5% dip maybe in the prices, the buyers come in very quickly to pick off shares, and the average investor, unless you're at the keyboard, really doesn't have a chance to take advantage of that dip. So let's just say on the red days, you might want to start accumulating in advance of the Fed going dovish because they're probably done raising rates. And if they are done raising rates, and once they officially announce that tonality to their Fed speak, we will then see these stocks rise 10, 15% just on that basis. But the number one reason you buy these stocks is because even if the economy becomes an undynamic marketplace, and the economy starts to slow down more than anybody anticipated, or the Fed has to continue to raise rates, or inflation rears its ugly head, these companies are going to grow their revenues 10 to 15%, at least on an annualized basis. And so they're going to be showing forward momentum quarter over quarter. And so we're dependent on these companies, and we really can't live without them.
Yeah. You're watching the 50-day moving average. I mean, when you talk about, pulling back and trading below the 50-day moving average, even maybe prepping for an economy that's becoming worse. I mean, I don't know what your thoughts are on a soft landing, but what does it mean? And why are you watching the particular charts? What are they telling you?
Well, the economic data and the charts now are telling us that the Fed is probably done. There's a very small chance they're going to be raising rates going forward. And, the X factor there, of course, is energy. If energy prices start to go up, that will affect the CPI, but the Fed really can't do very much about that. The real culprit of inflation, and that nobody's talking about, Nicole, is the fact that the federal government's going to spend $2 trillion more than they collect this year. And that is a pseudo form of stimulus that Wall Street happens to love. And it's a dark little secret in the corners of Wall Street offices where the Fed is, not the Fed, but the budget is stimulating that so much in an oblique way to the economy. That's 5% of our GDP on the overspend. We really can't have a recession in that environment. Now, if the government was spending a lot less, then maybe so. But think about it like this. If we weren't overspending, do you think GDP would be in the black right now? Probably not.
Right, understood. Okay, what about the food inflation that you even used the word tapeworm. What does this mean? I like this phrase. I think you're making a good point.
Well, food inflation has been like the tapeworm on the pocketbooks of many Americans the last 2 years. We've seen groceries go up over 36% in 24 months. There are people maxing out their credit cards just to feed their family. There are people borrowing from their 401ks and IRAs and reserve savings for retirement just so they can cover the added expense, because incomes didn't go up 36% the last time I checked. As a matter of fact, wage inflation has stopped, and we've lost 1.5 million job openings the last 3 months, the most since COVID and the most in history other than COVID. And so the economy is starting to slow down. And so hopefully we'll see some of the inflationary aspects slow down. But, the packages are getting smaller and the expenses are getting more at the grocery store, Nicole.
Yeah, and that's the whole point. And the Fed obviously likely to take a pause now. Are you concerned about, when we get these inflation prints and the labor picture? Sentiment is likely on Friday to be a little lower. I'm waiting on inflation prints, retail sales, and I'm curious to hear what you think about the labor picture too.
Well, I don't think the reports that we're going to get this week on retail sales and the CPI are going to disappoint. I think the economy is slowing down much quicker than folks realize, and that lag effect is really going to start to take hold here over the next 2 and 3 months in the economic data that we're going to be getting. And so it's setting us up, we see, for an interest rate decrease probably before the end of the second quarter of next year. And so all the more reason to start picking off the shares that we've been talking about, the Metas, the Googles, the Amazons now, in advance of that economic data. But there will be some pain in economic data over the next 6 months. Nobody really knows, Nicole, how deep this is going to go from a recessive standpoint. I mean, over the last 70 years, when they've raised rates, 80% of the time it's ended up in a recession. And so is this going to be the one time, the 20% chance that we didn't have a hard landing or a soft landing or any landing to the negative? Nobody really knows. All the marketeers got the market wrong this year. So what makes them think they can get the economy right?
Yeah, I found it fascinating when I read today that the head of the central bank in Japan had talked about ending the negative interest rate policy just to try and pull some money back so people would, be wooed to invest there. I thought that was something that left me scratching my head too. All right, Jeffrey Small, Arbor Financial, thank you. Good to see you.